Because liquidity is 90% of all price action. Everything else is just us talking. 2026 is really important for the Trump administration to try and win. So they will do anything they can. We need to create about $7 or $8 trillion of liquidity in the next 12 months to pay the interest on the debts.
Raoul's core framework remains unchanged. Liquidity explains the vast majority of price action across all asset classes. Roughly 90% of Bitcoin's price movement can be explained by global liquidity, and for assets like the Nasdaq, that figure rises to nearly 97%. That means almost everything investors focus on, narratives, news events, even earnings, is secondary. Liquidity is the primary force, and crypto sits at the very far end of the risk curve. When liquidity expands, crypto is the first asset class to benefit. When liquidity contracts, crypto is the first to suffer. That is exactly what happened this year.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
It's just been a bit of a weird year. In the end, the S&P and Nasdaq did okay, but didn't do great. But some things did really well. If you had gold and silver this year, you're a god after stinking for, the 2 years prior to that. It's just like, over the long run, we know all of this stuff goes up because of debasement. But the nuances of what market, who'd have thought that the fourth year of a crypto bull market would be negative?
A down year.
Zero people. And then, it's like, it's been just tough for people. We nailed most of the year, even things like the M2 chart, like a gift. Now, I always said they weren't going to last forever. But everything started breaking apart in July a bit. And July was when the Treasury started rebuilding the general account, but we drained the reverse repo, which was the offset. So we had no real offset to the Treasury building up $700 billion. And so that kind of pulled the rug a bit from crypto because it's furthest out the risk curve. And then the shutdown happened and the next tariff war with China. And before you knew it, everything blew up. And so we've been diverging ever since in crypto because we're the furthest out the risk curve. And so the rest of the year was playing out almost perfectly. And I did not see the shutdown coming. 2026 is really important for the Trump administration to try and win. So they will do anything they can. So whether they have to somehow paper over the cracks in liquidity, if that happens again. We're still caught in a liquidity trap right now because the banks don't have enough liquidity. Year-end funding is a problem. The money markets were breaking. They probably still have to do something with I can't believe we've all had to learn about fucking plumbing, but here we are. They're going to have to do something with the standing repo facility to allow the banks to fund themselves into year-end. I mean, what a shit show. And we're still caught in that. And I just think that 2026, probabilistically speaking, has to be a good year because of liquidity, fiscal stimulus, and all the other stuff that's coming. Regulation changes, and a Treasury Secretary who really understands about the business cycle and how we need to jam it if you want to win the midterm elections. I mean, it's all there and they're telling it openly. Bitcoin dominance is driven by the business cycle. So if the business cycle is lackluster or early stage, then Bitcoin dominance tends to be higher. When the business cycle picks up, which it has not done because of liquidity and rates and stuff like that, then Bitcoin dominance remains strong. But the moment it changes, then everything starts to outperform. And Scott Bessent is telling you day in, day out, it's going to be a strong economy. And this is why all the forward-looking indicators suggest all of that. And I keep saying, you just extrapolate out the log trend of the market cap of crypto. We're at 3 trillion today. If you extrapolate it out into this nice little log regression like we all do on the Bitcoin chart, you get to about 100 trillion in 10 years' time or less by 2032, 2034. So if we're $100 trillion, we've got 97 trillion of wealth to create. That ain't just coming from the banking system. It's not big enough. It'll come from the wholesale adoption of everything using blockchain rails, digital ID, everything. When I look at the chart of interest payments and look at total liquidity, interest payments lead, and then we have to have liquidity to essentially pay for the interest payments. And that tells us we need to create about $7 or $8 trillion of liquidity in the next 12 months to pay the interest on the debts.
That's a crazy number.
It's
I'm old enough to remember when $1 trillion was a lot of money.
Yeah, that's right. And so okay. So that means we've got all this to go. So how does that come? Well, if we look at the changes to the SLR, this little innocuous 3-letter acronym, that probably brings 3, 4 to 5 trillion of liquidity that's driven through the banking system. Call it 3 trillion, call it 3 trillion for easy math. Then we've got the fiscal stimulus. Well, the fiscal stimulus probably adds $1.5 trillion into the banking system. So we're at $4.5 trillion. And we've barely started looking at what other levers that they can use. We've got the balance sheet rebuilding. They've got the drawdown of the TGA. Well, let's chuck in another trillion there. We're going to have $5.5 trillion. Okay, we're getting very close to the numbers. Now imagine if they then change the SLR fully and get rid of all the risk weighting. We're now immediately at 8 trillion. So without having to do any complicated maths, it's like
lowering rates.
Yeah, without even talking about rates. So the liquidity coming is big. Will it come exactly as I say? No. Will it all be smooth? For sure not. But generally speaking, that's the game we have to play. So that's what I look forward to in 2026 is like, if 90% of Bitcoin's price action is explained by global liquidity, then that's the most dominant macro factor of all time because it's 97.5% for the NASDAQ and, equivalent amongst all the asset classes. So therefore, we just need to worry about this one factor because everything else is noise. And this one factor says you need to print money because liquidity is 90% of all price action, which is boring. It's weird, but everything else is just us talking when really it's all done by that.
Crypto is not driven by institutions at the edges. It is driven by people, by psychology. Wall Street is not buying gaming tokens or meme coins. That behavior comes from participants who feel richer, more confident, and more willing to take risk. As capital rotates outward, narratives roll. One theme pumps, stalls, and then gives way to the next. This cycle feeds on itself. Layer ones with real adoption are the easiest trades. They sit at the intersection of quality and risk. DeFi, gaming, and experimental narratives may outperform, but they carry execution risk. Understanding this psychological rotation is just as important as understanding macro liquidity. Eon Markets' Raoul emphasizes something far more profound. The world is moving toward total digitization of information. AI runs on tokens, packets of machine-readable data.
Which is the same that drives small caps. It's the same that drives credit markets. It's all the same thing. It's the risk curve. So let's talk about the performance. So right now, I've always said, expect a 35% pullback in Bitcoin twice a year in a bull market. We've had 2 of those.
Yeah.
And then what happens is there's a risk curve. So ETH falls 40%, 45%. Solana falls 60%. SUI falls 74%.
And memes go down 99.9999999.
Correct, right? So there's your risk curve. On the way up, the opposite plays out. Now, it doesn't mean memes will go up, but generally if you're in the right part of that risk curve, without being too risky, you should get decent pickup from things that are less liquid and smaller, earlier phase, stuff like that. So that's generally how it plays out. And it usually happens quite fast, as we know. Now, we only have 12 months, and maybe they're not going to win the midterms, and we start figuring it out via prediction markets by September, and it's all like, oh, fuck. It's all over. So I don't know how long this thing lasts, but let's assume it's at least 9 months. So then, do we get the rolling narrative cycle? Generally, that's how it's worked, because when you're further out the risk curve, it's just degens who are buying it.
Right.
And we're always looking for the next tail chase. Where can we make the next money? Because it's not Wall Street coming to buy our gaming tokens or our memes. It's us lot fucking around with our capital because we're feeling like we've made some money. So we have to understand how our psychology. So I think we will have that rolling thing. But, generally speaking, the layer ones are so easy if they're higher quality, layer ones that have proven adoption. It's like that's a much easier bet. Whether your DeFi protocol or your gaming one or whatever will get adoption, we don't know. I mean, there's an interesting one, the thesis on Zcash that's playing out. Okay, it was an internal rotation.
What do you think of that? Yeah, I would love
So
to hear you.
there was an internal rotation because the market was going down, it went up. Okay, fine. We've seen that 100 times before. Everyone gets trapped in the top. The market stabilizes and it plunges again. I think there's a decent chance that becomes a real narrative. And people, when the market goes up, it fully goes up again. But I don't know, because most of us who've been in crypto for a long time are tired of fighting the government. And I just don't know if I want to do that all over again. Oh, no, it's entirely been muted. So what they did is, it was Steve Mirren was the plant in all of this. Right. Steve Mirren basically said that, he was the architect of a lot of the Trump tariffs. But then he went into the Fed and started talking about the ESLR changes. And these three-letter acronyms, we always know mean something, but they pretend they mean nothing. And really what it is the amount of treasuries, the risk weighting of treasuries on a bank's balance sheet. And because of after the financial crisis, they made them quite risky on a balance sheet. So banks didn't have a lot of it. And hedge funds were providing liquidity and others. And they made this little change to say, we're going to reduce risk weighting. It's a tweak. Basically, what it was setting up is for the banks to buy the debt. So they buy more debt, they use it as collateral, they then leverage it out and create loans. And that flows through the whole system. Scott Bessent was saying in a different way, he's like Main Street over Wall Street. So Wall Street, what his definition was quantitative easing was a gift for Wall Street, of course, because assets went up. And it didn't do anything for the economy, really. But when you do it via the banking system, loans go up, and that helps everybody. So loans were tight beforehand, so loans become easier, is the idea. Then they also talked about they wanted the Treasury not to use the balance sheet as the primary mechanism of liquidity. And so they stopped QT, fine. Then they've had to technically add to the balance sheet. But what they're saying is, we don't want the Fed to add the liquidity, because then we're beholden to them for their use of the balance sheet and for interest rates. And those guys are not aligned politically with the fact that we have to pay for all of this debt and issue new debt. So what we're going to do is we're going to change the regulations, neuter those guys, force them into lowering rates, try and get new people into the Fed to keep rates low because we need to roll the debt. That's game number one. Meanwhile, we'll now get the banks to change it. The moment the SLR was kind of rushed through at the end of the year, it comes in January now, and is mandated by April 1st. Mirren came out the same day they announced it and said the risk weighting should go to 0. And what he's saying is we want to jam the banks with unlimited amounts of treasury bond issuance. So now we've got a buyer. So they've completely neutered the Fed. Pressing urgent current need is, in a world of AI, we need authentication of humanhood. Right? So tokens and zero knowledge proofs is a great way of authenticating that Scott is Scott, Raoul is Raoul, because soon there's a million videos of you and some of them aren't the real ones, some are the real one. Yeah, how do we do all of that shit? That's urgent. You saw Kathy Woods congratulating some couple online. It was bloody AI. And it was like, okay, it's so close to creating a big election problem. I mean, by the actual general election, better fucking have sorted this shit out, because any state actor, any bad actor can spam the internet with everything and nothing is real.
Yeah.
And that's the collapse of society, when there is no source of truth whatsoever. So that's a pretty big use case for this stuff. And then we're saying, okay, there's a bunch of people who are saying, well, we can make bots from AI trading stuff. Okay, fine. I mean, hedge funds have been doing that kind of stuff forever, blah, blah, blah. It'll get better and better, fine. Then there's the other world, the world that Ribbit Capital have talked about and I've written about, is, and it's an expression I've used with you in the past as well, is like, tomorrow will be more digital than today. All information is now being tokenized. Tokenized, we have tokens that feed AI. That's how AI trains itself. It's on tokens, they're data tokens. The token is a packet of information that is machine readable. So if you would tokenize a physical book or a physical photograph, you have to make it machine readable, various formats. That process to make it readable by the AI is creating tokens. When we're moving to these super squid that suck everything, which is all the AI, all knowledge, you're going to have to tokenize extraordinary amounts of data, right? All of the data. If you want to get to ASI, the race is how much can you suck out of all this knowledge? Most of this data is private or others are difficult to get at. Or it's held within scientists, universities, governments, and all of this stuff. So once you tokenize it in the packets of information, you can then trade it via tokens, i.e. on a blockchain. What does that all mean? What is Raoul talking about? I'm talking about gigantic global instantaneous marketplaces for data that trade 24/7. We won't be the participants, it'll be agents pulling data, trading data, collecting data, looking for patterns in data, and building the AI itself, the AI beasts themselves. That becomes, everything becomes a marketplace, all information, everything. And why? Because it is the only way to incentivize everybody and everything to share their data. Every marine biologist will take every single reading they've ever had, everything about the reefs, every single bit of information, and sell it via tokenization. You'll have every university, all of us as people might want to feed the AI our photographs. You know, we've all got hundreds of thousands of bloody photos from our phones. Can we get paid for all of that? Okay, that's interesting.
If you extrapolate crypto's market cap using a logarithmic trend, the same method applied to Bitcoin historically, you arrive at a staggering conclusion. Crypto could reach $100 trillion within the next decade, potentially by 2032 to 2034. That implies $97 trillion of new wealth creation. This does not come from banks alone. It comes from wholesale adoption of blockchain rails across finance, data, identity, AI, and global commerce. Tomorrow will be more digital than today, and the day after that even more so. This year felt broken, disorienting, emotionally draining. But nothing fundamental failed. The system simply ran out of liquidity, and crypto, sitting at the edge of the risk curve, reflected that first. Now, the conditions for reversal are forming, quietly, bureaucratically, through regulatory tweaks and balance sheet mechanics most people never notice.